So in this video, we are going to discuss about dividend and dividend policy. So these are the contents of this video. So we are going to discuss about what is retained earnings, dividend policy, the factors affecting the dividend policy, dividend as a signal, and the theories of dividend policy, which are residual theory, irrelevance theory, and what is scrip dividend and share repurchase. So we'll start with what is retained profits. So retained profits is also called as retained earnings or reserves. So it is like directly linked with dividends. So we'll discuss about retained profits. So retained profits is available only for a business which has been trading for more than 1 year. So any company which is like been established for more than 1 year, they will have a retained profit. But still, the company has to make a profit. So because only when they make a profit, that gets added to the reserve. So it is when the profits made are plowed back into the business. So the profit which is made in earlier years, that is again put into the business. So this is a source of funding for the company. So it is a long-term source of finance for a company. So we can take it like this: the net profit after interest and preference. So the net profit after interest, tax and preference dividend is available for the equity shareholders, but the company can either declare that profit as dividends, or they can send it to the retained earnings. They can retain it and that can go to the reserves part, and this money is available for further investment or further dividends in the future. So we look at Pidilite company, okay, the company which makes Fevicol. So this company, if you take, they are making consistent profit. So over a period of years, the company seems to be making a consistent amount of profits. All these profits are either declared as dividend and or they are sent to the reserves. So we will take any particular number. So we'll take this year's number, 2011. So in 2011, the company has made 310 as their net profit. 30% of that amount is declared as dividend. So out of 310, there's a dividend part and there's a retained earnings part. So the dividend is 30%. That means 70% is retained. So 30% refers to around 100. So the balance 210 should be in retained earnings. So we'll check whether the retained earnings has been added to. So the profit has been added to retained earnings. We'll check. So the year which we are looking at was March 2011. So in March 2011, we had sent 210 to retained earnings. That means the earlier year had a reserve of 820. So March 2011 should have 1030 as their retained earnings. So they have approximately 1034. So the profit is sent into two ways, one as dividend and the other one to the retained earnings or reserves. So this is where the reserve got added. But not all companies can do this. Only when a company has profit, they could send it to the reserve. For example, this company seems to be having a loss of 400, and there is no dividend because it is a loss making company, they cannot make dividends. So what happens is their return earnings might go for a negative. So the year which we are checking is March 2009. We will check in March 2009 what has happened. So in March 2009, in 2008 the reserves was 4465, and in 2009 there's a minus 400 in profits. So that should have come to 4065, but the number seems to be 3000. So it seems that the company has used the reserves from 4065. The company has used around some 1000 from the reserve. So the reserve has still fallen to 3065. So approximately that's the number. So partially the loss has reduced the reserve, and the company has also used some of its reserve. So reserves are available only for a profit making company. A loss making company will see its reserve falling down, and reserves can also become negative. So what is the usefulness of having reserves? So this money is not, it doesn't need to be repaid to shareholders. So the company can retain it, they can invest it, or they can just hold it for any future contingencies or emergencies. So no interest is payable on this amount. So it doesn't have much of a cost. But what's the disadvantage? If you're a new business, then you might not have a reserve, and it business may not make enough profit to plow back. So the company has to make a sufficient amount of profit so that it is being used in the reserve. So that's about internal source, which is called as retained earnings. So now we'll move on to the dividend policy. So dividend is part of the company's profit, which is given by the company to its shareholders. So dividend has to be given to the shareholders at periodical intervals, but there's a problem. When there's a volatility in your dividend, this year you give very high dividend, next year you don't give a dividend, then you give a very high dividend. This kind of dividend should not be like issued. What you should have is you should have a policy. So policy gives some kind of a stability or comfort to the shareholders, and they know what to expect from the company in terms of dividend. So a dividend policy is very useful for a company. So if the company retains all the profits, then shareholders are deprived of dividend income. If the company pays out all the profits as dividends, then the company may not have enough funds to reinvest and run the company. So investors want a stable policy as to how much they will receive in the form of dividends every year. And this kind of uh, pattern of paying dividend is called as the dividend policy. To satisfy the shareholders' expectation, the company should create a framework for dividend policy as to what to expect from the company in terms of the dividend. This helps the investors to avoid both the surprise and shocks. Okay, so a dividend policy is like very mandatory for a company. So now we'll move on to the types of dividend policies that a company can pursue. So one is called as the constant dividend per share, and that can be divided into two parts. So one is called as without growth and with growth. Okay, so there's a constant dividend per share, and that dividend seems to be not growing at all, it's constant, or there's a chance that it can grow. So there are like two ways it can move. The next one is called as constant payout ratio. The third one is irregular dividend, and the last one is no dividend. So we look at the constant dividend per share model. So here what happens is, whatever happens in the company or in the outside of the company seems to be paying a constant dividend per share. For example, whatever happens, they pay the same amount of dividend. So you can look at this chart. The chart will exactly tell you. So this is called as constant dividend per share with growth. So they start at a lower base, then every year it also grows. Okay, but there is the dividend paid is like constant. For example, they might have started at 10 rupees. Every year they paid an additional 1 rupee, so that becomes 12, 13, then 14. It can be amount wise constant, or it can be also like percentage wise constant. For example, 10, another next year it could be 10 plus 10%, so it becomes 11, then it becomes 11 plus 10%, that becomes 12.1. so it can be in either way. It can be percentage wise, it can be constant, or amount wise it can be constant, or there can be another method, constant dividend per share without growth. There's no growth at all in the dividends. Okay, so it's going to be very constant, and that is the second type of model. So now we will move on to the constant payout ratio. So in the earlier constant dividend per share, the amount was constant. right? In dividend per share, okay, in constant dividend per share policy, the dividend per share was constant 10 rupees. Then it can, if it's growth, then it goes to 11, then it goes to 12. But in constant payout ratio, the percentage, the constant payout ratio, the percentage is constant. So for example, we could see here, for example, suppose a company set the payout ratio at 10%, then this percentage of profit will be paid out as dividends every year regardless of the quantum of profit. So however the profit moves, out of the profit 10% will be declared as the dividend. We can look at the chart for this. So the chart you can see, so this is the EPS, okay. Out of the EPS, the DPS also is constant. So whenever there's a high profit, the DPS is also high. Whenever the profit falls, the dividend also falls, okay. So whenever it again falls, it again falls. So if the, if we set it as a 10%, the constant payout ratio is set as 10%, then if there's a profit going to be 100, dividend will be 10. If the profit is 50, then the dividend will be 5. So as a percentage, it's constant. So we'll move on to something called as an irregular dividend. In irregular dividend, there's no kind of a policy set. We can say that there's no policy at all for this company. Whenever they feel like they can issue the dividend, they will give the dividend. But whenever the board of directors feel that they don't have sufficient money, they can also stop the dividend. So it purely depends upon the board of directors. So irregular dividend is actually not a very good policy for a company. So the next one is called as no dividend policy, where the payout ratio is fixed as 0. So the company feels that rather than giving dividend, they could retain all the profits, and that profit can be utilized to grow the business much more. So for example, startup companies or tech companies like Google, Facebook, they usually don't try to give dividends because they have much more higher growth and they need more money. So rather than paying the money as dividend, they reinvest in the company. And even shareholders are accepting this because they feel that rather than having the dividend, it's better to have share price appreciation, okay. So that's how investors are looking at. So this is a chart for no dividend, that's constantly it's held at 0. So we'll move on to scrip dividend. Whenever a company pays a dividend, it usually has to pay cash, but rather than paying cash, the company can also go in and give a new share as a dividend, okay. So what happens when this is given is outstanding shares will increase, the total number of shares in the company will increase, but the stock price will proportionately fall. So that's about the scrip dividend. So what are the pros of this? Number one, no cash is being spent, so cash can be retained for reinvestment. Unless the scrip dividend is like very big, okay, the share price will not fall to a huge extent. So for example, for every 100 share, one share is given as a free scrip dividend, then only 1% of the share price will fall. But if you are going to issue 10 shares for every 100 shares, then the share price will fall by 10%. So the fall in price depends upon the number of shares being issued as scrip dividend. So this also reduces the company's gearing because the company's gearing ratio is defined by debit by equity ratio. Whenever more shares are issued, the equity part of it rises. So what happens, the overall ratio, okay, as the denominator rises, the overall ratio falls, okay. So it reduces the company's gearing and thus increasing its borrowing capacity. As the overall ratio is falling, the company can now raise more debt to compensate the rise in equity, okay. So that's what it helps. Tax advantage, as as it is not cash and it is shares, it depends upon certain countries. In certain countries, cash dividend is taxed, but scrip dividend is not taxed. So in some companies, the shareholders can claim a tax advantage, but it's not always. So what's the problem? In few countries, whether it's cash dividend or scrip dividend, the tax has to be paid. So sometimes whenever a scrip dividend is issued, then as it is not a cash dividend, the cash has to be paid as tax from the shareholders pocket. Okay, so that's how it works. So now we'll move on to bonus share. So bonus issue is a method of altering the company's share capital without raising cash. So if a company has a high amount of retained earnings, that retained earnings can be converted into share capital, and only profit making companies can go for a bonus issue. By issuing a bonus, nothing happens actually. So for example, if you have a share which is trading at 100 rupees and you have around some 10 shares, so you'll totally have a worth of 1000 rupees of share, but and additionally you get one share for free. So this share doesn't have any cash and all. You get one bonus share. This is just a one bonus share. Okay, so the total number of shares that you have are 11 shares. Okay, and what would happen to the price? The price will actually fall to how much? The price will fall in this ratio. So the total worth of shares is 1000 rupees. Okay, earlier you had 10, but now you have an additional one. So the share price will collapse. It will collapse to a price of 90 rupees per share. So the share price will collapse to 90. So 90, we can put it like 90 or 90.91 or something. When you multiply, you will get the same 1000 rupees. So the concept is this: amount will remain the same even after the bonus issue. Okay, the share price will collapse. Okay, so even though you have the additional one share, you won't become rich just because you got a bonus share. Okay, so that's what happens. So we'll go on to a quiz here. Which of the following is most likely to increase shareholders' wealth? A stock dividend, a stock split, a special dividend? So a stock dividend is a scrip dividend. Okay, so even if a scrip dividend is given, you won't become rich. Stock split, you won't become rich. A special dividend, yes, because it's a special dividend, it's a one-time dividend and you will get cash in your hand. So the answer is scrip dividends make you richer. Sorry, special dividends make you richer. So we look at what are the factors which affect the dividend policy of a company. So every company has its own dividend policy, whether it's going to be constant payout ratio or no dividend policy or irregular dividend policy or a constant dividend per share. Whatever dividend policy they have, the policy is affected by these factors. Number one, how much of liquidity the company has, how much of cash the company has. If a company has a lot of cash, they can issue more dividend. If the company's liquidity position is very poor, they can't go for a high amount of dividends. So debt repayment needs. So if a company has borrowed a huge amount of money, then they have to pay interest and they have to pay the principal repayment. So those companies cannot issue a high dividend and they can't have a high dividend policy and all. So they have to settle for a lower dividend payment. If a company requires more capital requirements, for example, a company which has to periodically keep on buying more assets because their existing assets are like quickly depreciating, then these companies cannot go for a high dividends. They have to settle with a lower dividends. Profitability, the higher the profitability, higher the dividends. Stability of earnings, there are like few companies like FMCG companies like Hindustan Unilever, Nestle, or mining companies like Neyveli Lignite Corporation or Coal India. These companies have a very stable earnings, so these companies can go in for constant payout ratio or constant payout ratio with growth. So other companies cannot go for this kind of model. Business cycles, there are some businesses which are cyclical in nature. For example, steel companies make a huge amount of profit in boom years and they make very less amount of profit in depression years. So what happens is they have to settle in for a constant payout ratio kind of a policy, because whenever they have profit they can declare 10% out of it, whenever they have low profit they can declare 10% of that. So they can go in for constant dividend payout ratio or growth of the company. If the company grows really well and really fast, these companies need more money to grow their business, so they won't declare anything as dividend. For example, Google, Facebook, or any startup companies, they can't pay dividends. But those companies which are in a mature position, such as Hindustan Unilever, Nestle, these companies are in a very mature kind of business, so they don't grow and all. So what they do is they declare more amount of profits. And the last one is legal requirement. When some companies have issued bonds, the bondholders create something called as a covenant. So covenants are restrictions which are placed upon the company. So one of the restrictions can be like bondholders will say you should not pay dividend as long as you are not paying the interest. So that can be a rule like that. So if the company has agreed to the rule, they have to follow that rule. Or in terms of dividend taxation, so if the dividends are taxed at a higher rate, the company will not issue dividends at all. So these are the things which affect the dividend policy of a company. So we'll move on to the theories of dividend policy. So we'll start with a residual theory. So this theory is a very interesting theory. It says if the company has an investment opportunity, if investment opportunities are available, then the company should not pay the dividend. Instead, they should invest in the opportunity which is available. If the company has no investment opportunities, then they can pay the dividend. For example, the net profit after interest, tax and preference dividend should first go into capital investment. Okay, so whenever there's an opportunity, first utilize that. Whatever is remaining after utilizing for capital investment, that can be paid as dividends. So that is what residual theory suggests. So what happens here is the dividends fluctuate because every year the investment opportunities keep differing. So every year we can't like promise a constant uh, dividend per share. What we can maximum do is after the paying the capital investment, we'll pay whatever it is. So at one point of time, this becomes the irregular dividend policy. So shareholders are not like affected because of this, because what happens is every shareholder needs two things. One is dividend he wants, or two, he needs capital appreciation in the share price. Okay, these two things he want. So it works like this: if the company declares high dividend, then he doesn't want much of capital appreciation. Okay, but if the company declares no dividend, then he wants more capital appreciation. So it works like vice versa. If the company can give both, then he will be like very happy, but that doesn't happen at all. So the company can either increase one and decrease the other one. Okay, and vice versa they can do it. So we'll move on to the next theory. It's called as irrelevance theory. This is a very interesting kind of a theory. So this theory states that dividend decisions does not affect the shareholders' wealth as well as the value of the firm. So in this one they say that it doesn't matter whether the company has a dividend policy or not, because this theory suggests that even if the company is not declaring any dividend, okay, the shareholder can create his own dividend policy. Okay, sounds very different. So even if the company does not have a dividend policy, the shareholder himself can create a dividend policy. How can he create a dividend policy? For example, you can see here when dividends are not declared, okay, the share price which a shareholder has is 10 rupees, dividends are 0. So so as there is no dividend, the share price will also be constant. So the total worth of the shareholder's wealth is the dividend of 0 plus a 10 of share price. So he will be having the same 10 rupees of worth. If dividends are declared, what would happen? If dividends are declared, okay, if a company declares a dividend, the share price will proportionately fall. So if the company declares 1 rupee as a dividend, the share price will become 9. So the share price is 9 rupees. Okay, the new share price is 9 rupees and the dividend is 1 rupee and the shareholder wealth is 10 rupees. So it works in the same way. For example, we'll take like the same company is declaring a dividend of 3 rupees. The share price will fall by 7 rupees. So 3 plus 7 will again give you the same 10. Okay, so the logic works like this. He says that, okay, the theory states that the share price will fall in tune with the dividends declared. So even if the company does not have a policy, the shareholder can create his own policy. So whether the company declares dividend or it doesn't declare dividend, the wealth of the shareholder remains same. Okay, so we'll move on to the next theory. It's called as dividends relevance theory. So what is a relevance theory? Relevance theory states that a company should have a dividend policy. Okay, so that's what relevance theory says. See, dividends are not just amounts which is given to the shareholders. Dividends are also a signal that is sent to the shareholder from the company. Why? How can that can be a signal? Whenever a company announces an increase in dividend, okay, it can be taken out mostly as positively in the market and helps in building a very positive image for the company regarding the growth prospects and the stability in the future. For example, if you are running a company and you are declaring a good dividend and you say that next year I'm going to increase the dividend, it means that you are very confident in the ability of your company that it will make profit in the next year. So whenever you declare a high dividend, you are sending out a statement or a message to the shareholders that you are very confident. Okay, but a sudden cut in dividend will have a sudden cut in the dividend will have significant impact upon the equity share value. So you should not cut a dividend very quickly. If you cut a dividend, that sends a signal that the company is not able to pay dividends at all. So the company is expecting a fall in profit or bad times. So as a result, companies tend to adopt a stable dividend policy and keep shareholders informed of any changes. So what should we do? As dividend also works as a signal to the shareholders, we should send the signals very carefully. Okay, so just because we have high profit, we should not give a very high dividend, and just because we have a loss, we should not cut the dividends. So what should we do is we should have a stable policy, and if anything happens suddenly, we have to send a message saying that we are going to reduce the dividend because of these things, and the share price will change accordingly. So dividends acts as a signal. So how do you use these theories in your exam? In your exam, you should be like comfortable with all these theories, and whenever a question comes to you saying that the company wants to create a dividend policy uh, or the company wants to cut its dividends, do you think shareholders will react? So it depends upon the theory. In some theory, for example, in irrelevance theory, it says that shareholders will not react, but in relevance theory, it states that the shareholders will react. Okay, so whether shareholders will react or not react, both there are two theories here. You have to remember both the theories and you have to write both the theories as answer and say that these theories are indicating like this. Okay, and you can make a conclusion. The conclusion depends upon your view. So the conclusion is your view, but you have to state the theories. So we look at share repurchase. So share repurchase can also be called as share buy back. Okay, it's also called as buyback. So a share repurchase is a program by which a company buys back its own shares from the marketplace, usually because management thinks the shares are undervalued, reducing the number of outstanding shares. The company buys shares directly from the market or offers its shareholders the option of tendering their shares directly to the company at a fixed price. So what is a share purchase? Assume a company has 1000 shares and each share is worth 10 rupees. So totally the share capitalization is market capitalization is 10,000. Okay, the company feels that the company's share of 10 rupees is like very cheap. Okay, they feel the share price is really worth more than 10, so something like 20 rupees it's worth, but the share is trading at a very cheap rate at 10. The company also has a high amount of cash, so what they do is they try to buy back. Okay, so what they do is they say that we'll buy these shares at 12 rupees. So shareholders, what they do is, some shareholders feel that rather than having the share at 10 rupees, the market price is 10, let's sell to the company at 12. So if this happens, what would actually quite happen is, okay, the total number of shares get reduced. So they will get reduced by, we'll put it as 900. The market capitalization will be the same 10,000, but the number of shares have been reduced. So this number would become 10,000 divided by 900. So that would give you somewhere between, I think, 11.1. Okay, so the new share price would be 11.1. That you are an individual shareholder, you have 10 shares of this company, okay, and you hold 100 rupees worth of those shares. You have not participated in the buyback, so you already have the same 10 shares, but the share price has gone to 11.1. So without doing anything from your part, you have become richer. So is this possible? The answer is yes, because the company can keep on buying back their shares for a longer period of time. At one point of time, there won't be any shares left in the market itself. Is there an example for this buyback? Yes. You can Google for a company called as Cadbury, the chocolate that you eat. They have bought back all their shares, and they have also gone out of NSE and BSE, so you can't buy their shares at all. Or another company which does this brilliantly is Berkshire Hathaway. Okay, Berkshire Hathaway, they also consistently buy back their shares, okay, or they go for share repurchase. So you can Google that. So what is the advantage of doing share repurchase? Number one, it increases the EPS. How? So earlier, if you say that your total profit is 100 and you have 100 shares, then its EPS is 1. So now the same profit is 100 only, but the number of shares has become 90. So that gives you 1.11. Okay, so without doing anything in the profit, you can simply, when you buy back the shares, the EPS increases. It also increases the share prices. That's what we saw. It increased from 10 rupees to 11.1 rupee. Rising dividends, as lesser shares outstanding. So earlier you had to pay a high amount of dividends to 100 shareholders, but now you only have to pay dividends to 90 shareholders. ESOP, so even if you give employee stock option plan, employee stock options plans, once you are given, the number of shares will rise, but if you do buyback, the number of shares will reduce. So ESOP and share stock repurchase acts in set of manner, they work in set of manner. Reduced takeover threat, as the number of shares issued is lower. The lower your number of shares, then the threat of takeover is reduced. For example, if you say that only 20% of the shares is with the founder and 80% is traded, okay, if this 80% in the stock market, it's available. If some person buys this out of this 50%, 51% of the shares, then he will become the owner. Okay, so rather than having like a huge amount of shares, if you have a lesser amount of shares, for example, if the share ownership is 40% and this is 60% in the stock market, then it's like very difficult to buy 51% of the shares, because the 60% would be with several people, and buying 51% in that is like really difficult. So the concept is, the total number of shares in the market should be less excess cash. So stock repurchases reduces the cash. Some companies have huge amount of cash, so they want to reduce the cash in their balance sheet, so they go for share repurchase. It's a positive signal. So if the shares are repurchased at a higher price than normal, okay, then it is not a wise decision. For example, if the intrinsic value of the company's share is 10 rupees, okay, and we have a share buyback of the same shares at 20 rupees, okay, this is not wise, because the company's real worth itself is 10. We should not buy back at 20. So we should buy back at a lower price, for example at 5 rupees. If the intrinsic value is 10 and it's available at 5, then we should buy it. Number 2 disadvantage of stock repurchases: cash can be used in better projects. See, the objective of a company is to run their business and not to keep on buying back their shares. Okay, so cash should be deployed in growing the business and not in buying back the shares. And stock repurchase can be used to cover up dilution in ESOP. I think this is what we saw earlier. So we look at this quiz. When a company goes for share repurchase with cash, what happens? Okay, assets and shareholders equity decrease. Is it true? Asset will decrease because cash is paid to buy the share, so asset will decrease. Shareholders equity will decrease. Will it decrease? Yes, because the number of equity shares is bought, so shareholders equity will decrease. Leverage increases. The question is, what is leverage? For example, we have a hint here. Leverage refers to debit equity ratio. Okay, not only debt, it's debit equity ratio. So leverage increases. Does leverage increase? For example, before buyback we might have 100 debt and 100 equity. The answer is 1. After buyback, debt is 100 but equity would be 90 because we have bought the equity share, so the answer would be 1.11. so the leverage increases. Okay, so the answer is A. B is not the answer, even though this part is correct. Okay, leverage remains unchanged. Does the debit equity remain same? The answer is no. Leverage increases. Yes, this part is correct. But shareholders equity decreases. This is also correct. Asset remains unchanged. This is wrong. This is wrong. So again, this is wrong. This is wrong. So the answer should be A. So this is a question from the past paper. This question has been asked in the specimen 2016 question paper. So it is not actually a question paper, it is only a specimen paper. The question is, discuss whether a change in dividend policy will affect the share price of a company. No. Once you declare dividends, the share price of a company will fall proportionately. So if you declare a dividend of 1 rupee, the share will fall to 9 rupee. If you declare a dividend of 3 rupee, the share price will fall to 7 rupee. So the share price will fall, but for this you have to argue with dividend irrelevance theory. Then only you will fetch the marks. So thank you very much for watching this video. We'll meet in the next video.